Thank you very much, Dan, and to AJ Bell for having me today. As Dan mentioned, my name is Emma Bird, and I am the Head of Investment Trust Research at Winterflood Securities. And over the next 15 minutes or so, I'll just go over some more kind of key features of the investment trust structure and how that can provide advantages over other types of funds. So if we go on to the first slide. Thanks. So just as a bit of an introduction to myself and Winterflood. Winterflood Securities as a firm is primarily a market maker, so providing liquidity for trading in various financial instruments. But the firm also has an investment trust team which offers a full broking service, so essentially an investment banking model. So it has corporate finance, sales, trading, and research, which is the team that I head up. So that research team historically has provided research on the entire UK listed investment trust sector for professional investors who subscribe to our research as a firm. But we have actually relatively recently launched a new product, which is designed to provide investment trust research to retail investors free of charge. And so anyone listening to this is able to access all of our historical reports via winterflood.com/fund insight. We actually published a new report today. And you can follow us on LinkedIn on this link there, Winterflood Research. And that's the best way to get alerts for when we've published a new report. So going to the next slide, please. As Dan mentioned, there are a number of different types of investment funds, which will essentially provide access to a portfolio of underlying assets. But investment trusts have certain characteristics that can provide a number of advantages. So that includes having a fixed pool of capital and being closed-ended, being well suited to investment in illiquid assets, being able to use revenue or capital reserves to help fund dividends to shareholders, being able to use gearing or leverage with the aim of enhancing long-term returns, and having an independent board of directors to act in the best interest of shareholders. So I'll go through each of those in more detail. We move on to the next slide. So as Dan mentioned, one key difference between investment trusts and what are called open-ended funds, so what maybe most investors possibly more familiar with, so things like UCITS funds or OEICs, is that investment trusts are closed-ended. So they're listed on the stock market, and that means, like other companies on the stock market, they have a share price. And this is driven by demand and supply. So there are more investors wanting to buy than sell, the share price will go up, and vice versa. And this differs to the NAV, which is the valuation of the pool of assets. But when an investor buys or sells an investment trust, it only affects the share price. It doesn't affect that permanent capital, fixed pool of capital that the fund manager has to invest. I.e. they don't have to deal with inflows and outflows like an open-ended fund manager does. And this has a number of advantages. Firstly, it enables truly long-term decision-making. So a fund manager has this fixed pool of capital. They will invest in what they want when they want to do it. They don't need to be forced sellers of assets at an inopportune time just because they're receiving redemptions, so they need to sell to fund that. And equally, they don't need to invest at what they might view as being potentially the top of the market just because they're receiving inflows into the fund. And they also don't need to hold a pool of cash to fund any potential redemptions, which can provide a drag on returns. And this fixed pool of capital also makes it an ideal structure for holding illiquid assets. These liquid assets can be in a variety of forms. For example, physical illiquid assets, so for example, property, and so investment trusts that viewers may have heard of, for example, Tritax Big Box REIT is a property investment trust that involves in physical large warehouses, obviously very liquid, meaning that you can't easily buy or sell them, particularly in small sizes, or physical assets such as infrastructure. So an investment trust like Greencoat UK Wind invests in physical wind turbines, wind farms. Or there could be other illiquid assets like unlisted equities. So you'll hear from Scottish Mortgage Investment Trust later. That makes good use of the investment trust structure by having a sizable allocation to unlisted equities. Or other funds, for example, H2 Capital Trust is a more traditional private equity investment trust, so primarily has controlling or majority stakes in private companies. But the illiquid assets could also just be kind of listed small cap companies, which have a less liquid secondary market due to them being smaller and having a smaller pool of buyers and sellers. So an example would be an investment trust called Odyssean Investment Trust, which has a concentrated portfolio of pretty small sized UK companies, and that is a strategy that's very difficult to replicate in an open-ended funds in an open-ended structure because of the difficulty of dealing with inflows and outflows and having to regularly buy and sell the holdings to fund redemptions or deal with inflows. And I think the benefit of the investment trust structure for liquid assets is well demonstrated by the property space. So there have historically been a number of open-ended property funds, so open-ended funds that invest in physical property. But these have seen significant issues in recent periods of market volatility, namely COVID or around the Brexit vote. And these open-ended funds were forced to gate, so they stopped investors being able to withdraw their money because sentiment had turned so negative to real estate. These funds were seeing a lot of outflows, and they couldn't fund these outflows. They couldn't convert their assets into cash quick enough, and it obviously takes time to sell a whole office building, for example. They can fund these outflows quick enough, and they had to gate, and investors were forced to stay invested. Conversely, property investment trusts, they saw the same investor sentiment shift. They saw sentiment turn negative, but this only impacted the share price. The discounts widened, but there was still kind of a secondary market. Investors could still sell if they wanted to. It may have been a significant discount to what the underlying asset value is being valued at, but investors were not forced to stay invested. As we go on to the next slide. Something else that Dan touched on was that unlike open-ended funds, which are required to pay out all of the income that they earn during a financial year and out to shareholders or to investors, investment trusts can keep up to 15% of their revenues each financial year in reserve. And these revenue reserves can be built up over time and then used to top up dividends in years where the underlying income earned by the fund is not sufficient to maintain the dividend. And again, we saw a number of equity income investment trusts utilize this during COVID. So during COVID, a lot of companies were forced to suspend or cut their dividends due to lockdowns affecting their revenues. And that meant that equity income investment trusts and open-ended funds both saw their revenues fall because they were receiving less dividends from the companies they invested in. Open-ended funds would have been forced to reduce their dividend on the basis that they were receiving less income in, but a number of investment trusts utilised their revenue reserves, so utilised income that they had reserved from previous years to either maintain their dividend at the same rate as the previous year or even to continue to grow it. So this means that investment trusts can provide much greater dividend certainty. They can help smooth dividends and can also provide stronger dividend growth records. So this has created a list that the AIC has put together, and the AIC being the trade body for the investment trust sector. And there's a list called Dividend Heroes, which shows investment trusts that have increased their dividends for at least 20 consecutive years. And City of London Investment Trust, which you'll also hear from later, is actually at the top of that list with 58 consecutive years of dividend growth utilising revenue reserves. Just something else to touch on in the dividend point is that investment trusts can also use capital reserves. So that means they can use the profits that they generate from selling underlying holdings and convert that capital return into income and pay that out to shareholders as a dividend, so an income for the shareholder. And an example of that is JP Morgan Global Growth and Income, which is a large global equity investment trust. Those managers invest in a portfolio of global equities, but they are unconstrained in their approach. They aren't specifically targeting companies that pay a dividend. They're not aiming to generate an income from the underlying portfolio, but the investment trust utilizes an enhanced dividend structure, so it converts some capital into income and uses revenue reserves, if possible, to pay a dividend target. So it aims to pay a dividend equal to at least 4% of the NAV as at the previous financial year end. And if anyone wants any more information on investment trusts and income or dividends, I actually recorded a podcast with Dan at the end of last year, and there's a link to it here if you want any more information on that. If we move on to the next slide. So another potential advantage of the investment trust structure is that they can use gearing, so that's borrowing or leverage, with the aim of enhancing returns over the long term, although investors should be aware that it can also exacerbate losses on the downside. The debt that investment trusts use to gear can be in a variety of forms, and can be bank debt, or it can be them issuing bonds, and there can be a variety of cost profiles, fixed versus floating rate debt, and the level of gearing as a percentage of net assets can also vary quite significantly from investment trust from one investment trust to another. So you should always do your research beforehand on how much gearing an investment trust uses and the structure of it. And again, if you want any more details on exactly how gearing does enhance returns or exacerbate losses, I did another podcast on gearing last month, and there's a link to that there, which has a lot more detail on technical details of gearing. But just as an example, again, no investment recommendation, but as an example of how gearing can enhance long-term returns, there is an investment trust called Fidelity Special Values, which invests in UK equities, and that has an equivalent open-ended fund called Fidelity Special Situations. They're both managed by the same manager, supported by the same team, same investment objective and strategy. But the investment trust utilizes gearing, so it had gearing equivalent to 11.5% of net assets at the end of March. And the investment trust has outperformed the equivalent open-ended fund over the last 1, 3, 5, and 10 years, as at the close of Friday. It also does actually use the investment trust structure to invest further down the market cap spectrum than its open-ended equivalent, so that will also be contributing to the difference in returns. And obviously, in down markets, the gearing will exacerbate the losses, but that's just an example of how gearing can really enhance returns over the long term and with the compounding effect. We go on to the next slide. So the final structural advantage of investment trusts, particularly open-ended funds, that I'll highlight is that investment trusts, just like other companies listed on the stock exchange, have a board of directors. And the key thing to note about investment trust boards is that they are independent of the fund manager. And their role as board is to act in shareholders' best interests. And that can include replacing the fund manager if performance hasn't been good, or if there's been a key change of named manager at the firm, or looking into implementing or enhancing discount control policies, for example, so increasing share buybacks or providing other exit opportunities for shareholders, or potentially initiating whole strategic reviews if they think the strategy is no longer relevant, which may end up in potentially proposing a merger with another investment trust, or just proposing to wind up the fund if they think that just returning cash to shareholders or offering a rollover vehicle. So there's lots of things that these boards can do independent of the fund manager in order to provide the best outcome to shareholders. And I think that this has been really reflected in recent years. It's been a difficult time for the investment trust sector. We've seen kind of record-wide discounts for a prolonged period of time, some disappointing performance at a number of trusts in a difficult market backdrop. And we have seen a record level of mergers in this space, a record number of strategic reviews and wind-ups. So boards are responding to this and implementing initiatives in the best interests of shareholders. And the just final thing to note on a related point is that because investment trusts are listed companies, then you are also able to vote on key issues affecting the fund. So there's kind of regular votes at annual general meetings will include the re-election of these independent directors, approving the renewal of share buyback or issuance authorities, approving director remuneration. But there are also a number of other either regular or ad hoc votes on real key issues facing the investment trust. That means you get a say in the future of the company, the investment trust that you're invested in. A number of funds have regular continuation votes, so there will be a resolution at a general meeting saying should this investment trust continue, and you can vote yes or no. So you can express dissatisfaction in that way. Or if there's a proposed merger or wind down, that will also be put to a vote for shareholders. So that's another key factor and differentiating factor for investment trusts. And just move on to the last slide. So just to conclude, that investment trusts do offer a range of structural advantages over other types of investment funds, and they can definitely be an attractive addition to investors' portfolios. And obviously important to do your research first, and there's some hopefully useful links on that page as well. So that was all I had prepared for today, other than probably a disclaimer slide that we should show, but happy to take any questions at the end of the webinar.